Welcome everyone to my latest video. In this one, I'll be going over my $235,000 stock portfolio, providing an overview of all the great businesses I'm invested in. And given its earnings season, I'll cover some of the reports from these companies. So buckle up, I'm hoping this one will be a good one. But before we get to that, a bit of an introduction. My name is Luke. I have an undergraduate degree majoring in finance, and I've been investing now for around a decade, but I really started to get into it around 2019 and during the pandemic of 2020. As many of you would have experienced for yourselves during that time, it was a really interesting time to be an investor. And I learned a lot about patience and resilience, but also one of Buffett's core beliefs, which is to be greedy when others are fearful. And I didn't have a ton of money to invest during that time, so I needed to make sure that the business I was buying was solid. Since then, I'm proud to say that I've achieved just over a 34% return per annum in my core portfolio. Over that time, I've primarily chosen to invest in companies with wide moats, strong revenue growth, and low debt. And for the most part, I want to invest in companies that I feel will continue to exist and be successful for a very long time. So if I suddenly went into a coma and couldn't touch my portfolio, I'd feel comfortable knowing that these companies would still exist if I woke up. Fingers crossed that doesn't happen though. So on that note, let's jump into it. But just first, an important caveat is to say that there is $70,000 which isn't included in my portfolio, which I'll explain at the end. Starting with my top investment, which is of course Google. Because of the recent run in this company, it now represents a really massive part of my portfolio, roughly $55,000 when you include my Class C shares. And the investment case for Google has been pretty straightforward over this time, but the journey certainly has not. If there are other Google investors out there, you'll know this for yourself, but it has been a little bit of a bumpy ride. There's been a lot of narratives which have disrupted the stock, including AI, regulation, and disruption of the core search business. But this has actually created a lot of investment windows for Google, and maybe not so anymore, but I'd argue that the stock has been somewhat undervalued for a lot of the last 5 years. So it's been quite an easy investment to continue to grow. And I think that now that Gemini has been a great success, investors have really started to see the case for not only that, but for the rest of Google's ecosystem as well. Google is essentially a toll bridge for the internet. And with the arrival of AI, it has actually complemented the search function as more users generate more data, which improves the product and attracts more advertisers, as we'll touch on with Meta later. Additionally, Google's cloud business continues to grow quite nicely. YouTube is one of the most dominant players in the streaming business, and it's investing in really interesting moonshot programs like Waymo. I'll have more to say on this next week when Google reports their earnings, but it'll be a really interesting one to watch, especially given the market's reaction to Microsoft's earnings, and we're probably going to see that Google increases their capex similarly to Microsoft. So it'll be interesting to see the market's reaction to that one. Moving on, we've got Bank of America, which makes up over $24,000 of the portfolio, and JP Morgan, which makes up over $18,000 of the portfolio. So around $43,000 altogether. And can I say, Bank of America and JP Morgan have actually been some of the easiest investments I've made in the portfolio. I rarely have to worry about what's going on over there, and this is largely due to their focus on building fortress balance sheets. With Bank of America, they actually had a pretty nice earnings report which just came out. However, the stock did fall on the news. They reported EPS of 98 cents, which actually beat estimates. Net interest income rose 12% year on year, and management expects that it will grow between 5 and 7% in 2026. Backed by a 41% increase in capital return to shareholders, which is in the realms of $30+ billion. Additionally, their digital adoption program is reducing their reliance on physical branches, thus reducing costs. However, the issue with Bank of America is that it is more sensitive to interest rates than its peers, so it will be interesting to watch the Fed this year to see if they reduce rates. Over at JP Morgan, it's a very similar story. Net interest income is expected to be at around $103 billion this year, which is 7% year-on-year increase, and they've just actually purchased Apple Card's portfolio, so that expands their high-yielding credit card business, which is really good. And I think similarly to how Google services act as a toll road for the internet, banks like JP Morgan and Bank of America are positioned well to start using blockchain technology as a toll road for transactions and payments. So JP Morgan has things like JPM Coin, and companies like Bank of America have tokenized deposits. So this will really help to reduce friction in the industry and speed up these processes, which I think is super important and one to watch. And with AI, we're starting to see this technology used for customer service, fraud detection, and other administrative purposes, which will hopefully help to reduce costs and improve productivity. Moving on to Meta, which makes up nearly $21,000 of the portfolio. My original thesis on this one was that the negative reaction to the shift to the metaverse was overblown and that their advertising business remained strong. Through that, they have access to over 3 billion users globally, and my theory was that they would continue to deliver strong results for the company. And this proved to be very correct. And in fact, Meta has just actually reported their Q4 earnings, and revenue surged 24% to $60 billion. Additionally, it appears to be somewhat of a beneficiary of the AI boom, with ad conversion rates up over 1% in Q4. However, Zuckerberg has guided 2026 capex of between 115 and 135 billion, which is up from $72 billion in 2025. And as we're seeing with companies like Microsoft and even Meta last year, shareholders aren't necessarily all that crash hot with these massive capex spends when there is no clear financial return to the shareholder. My concern is that capex may end up being similar to Mark's metaverse brainwave, which has cost the company upwards of $80 billion. However, Meta is printing cash with their advertising business, and I'm happy for now. And then we have ASML. It now represents just over $10,000 in the portfolio. The thesis for this one was pretty simple. ASML is the only company capable of producing the machines that make the most advanced chips, which are powering the AI revolution. It has a total monopoly on EUV lithography, and there is essentially no competition for its high NA systems. Encouragingly, in Q4, net bookings hit a record high of €13.2 billion, and management has guided 2026 revenue to between €34 and €39 billion. Its backlog also now stands at €38.8 billion, essentially guaranteeing revenue for the next 18 months. However, this investment isn't without risk. I think, as we've seen before, export restrictions may be put in place, which can put pressure on the business. And the final stock I'll talk about in detail today is Chevron, which makes up a more modest position of around $5,600 in the portfolio. The case for Chevron is that they're running low-cost, long-life assets in the Permian Basin and Guyana through the recent Hess acquisition. In their recent Q4 report, they reported a beat on EPS of 152. And even with lower oil prices, the company generated nearly $40 billion in cash flow from their operations, and Chevron is returning around $27 billion to shareholders in 2025 through buybacks and dividends, which is about a 4% increase. And I'll also just touch on some of the other investments in the portfolio briefly. So you've got companies like Rio Tinto, which some of you may know is a resources company primarily out of Australia. I am Australian. It's returned pretty well on capital gains and dividend basis. There has been a bit of a boom recently in resource prices, as I'm sure you're all well aware. And Rio Tinto has been a big beneficiary of that. And what will be interesting to watch on this one is whether it merges with Glencore. I'm not expecting that, but nonetheless, we'll watch it. And then you got Berkshire Hathaway. It's returned modest amounts. It's, I think, about 12% per annum, and I've owned that for, I think, around 2 or 3 years now. I'm a big fan of Warren Buffett. That's the primary case there, so I wouldn't necessarily look at my thesis too much on that one. And then finally, you have the software companies, the dreaded software companies. I'll put up a tweet from Joseph Carlson talking about the mental of a software investor. But yeah, these ones have just been absolute drags on the portfolio. Despite them, I would say, performing well as businesses. However, the artificial intelligence narrative has just continued to weigh down on their performance, despite them, delivering strong returns, I think, quarter over quarter, year over year, and really strong metrics. They're trading at some of the lowest valuations that they've ever had. So anyway, I'm still very confident that these businesses will continue to perform strongly. However, it's just this this AI narrative that will continue to be a drag, and whether they can sort of shake that. And then you've got Gitlab, and I almost would sort of lump that in with the software companies like Salesforce and Adobe. But I would just preface this by saying it is a very speculative investment, which is why it makes up, I think it's way less than 1% of the entire portfolio. So there are talks that I'm sort of keeping an eye out on, which is that they might be acquired. However, that seems very speculative at this stage. However, they just continue to, in my mind, to be a really great business. They're starting to even partner with a lot of artificial intelligence companies and start to integrate their services. Okay, moving on to my secondary portfolio, if you can call it that. As you may be able to tell, I'm Australian, and we actually have a compulsory retirement savings system, which we call superannuation. Our employers pay around 12% or more of our pay into our preferred fund, which we essentially can't touch till we retire. For me, this bucket of money has now grown to around $70,000, depending on the market. And as I'm relatively young, I've chosen to invest this in funds which are pretty aggressive, and that primarily constitutes US listed equities, emerging markets, and that sort of stuff. However, even those investments are very, very diversified. So it's not even as aggressive as I would per se like it to be. However, it's still returning, I think, around 15% per annum. So very strong returns. Anyway, guys, that's the entire $235,000 portfolio. I hope you've enjoyed this overview of the portfolio. I'm looking forward to covering a lot of these investments a little bit more in depth, just on an individual basis as they report earnings, as there's news that comes out about them. So hopefully we can look forward to more of that. But please let me know if you have any feedback, any questions in the comments below. Yeah, have a great day, guys.